10 U.S. cities where rents are rising faster than the national average in 2026, and the supply-demand math that tells you which ones are still investable. National rent growth in the U.S. averaged 3.2% in 2025. That number means nothing for individual market decisions. In some cities, rents are up 8 to 12% year over year. In others, new supply has driven effective rents flat or negative. The investors who win are not chasing the national average. They're identifying the specific markets where demand is outpacing supply, where employment growth is attracting migration, and where zoning constraints prevent new inventory from catching up. This is the 2026 rent growth heat map. The methodology. We rank cities on 4 inputs: year-over-year rent growth through Q4 2025, vacancy rate trend, rising or falling, employment growth percentage over 12 months, and net migration data, how many people are arriving versus leaving. A city that scores well on all 4 metrics is a structural rent growth story, not a temporary spike. Cities with high rent growth but rising vacancies and flat employment are likely normalizing from pandemic-era spikes. Avoid these for new investment. The sweet spot: cities where rent growth is accelerating, vacancy is below 5%, jobs are being created faster than housing, and net migration is positive. Numbers 10 through 6 on the rent growth ranking. Number 10, Raleigh, North Carolina. Rent growth of 6.8% year over year. Research triangle employment driving sustained demand from tech and biotech relocations. Vacancy at 4.8%. New permits elevated, but absorption is keeping pace. Number 9, Richmond, Virginia. Rent growth of 7.1%. Affordable entry point for DC area remote workers. Median rent still under $1,300 for a 2-bedroom. Number 8, Greenville, South Carolina. Rent growth of 7.4%. BMW and Michelin anchor employment base. Population inflow from Charlotte and Atlanta, reducing local housing inventory faster than permits allow. Number 7, Huntsville, Alabama. Rent growth of 7.9%. Defense and aerospace anchor. Redstone Arsenal, Blue Origin, and Boeing drove 6.2% employment growth in 2025. Number 6, Columbus, Ohio. Rent growth 8.1%. Intel megafab construction and semiconductor supply chain expansion attracting 30,000 jobs through 2028. Vacancy dropped to 3.9% in 2025. Numbers 5 through 3. Number 5, Colorado Springs, Colorado. Rent growth of 8.4% year over year. Military employment, Fort Carson, Peterson Space Force Base, NORAD, provides rent stability floor. Remote workers priced out of Denver driving demand. Vacancy at 4.2%. Number 4, Knoxville, Tennessee. Rent growth of 8.7%. University of Tennessee anchor plus Oak Ridge National Laboratory expansion attracting research and federal employment. Tennessee's zero income tax is a magnet for high earners from high-tax states. Median rent at $1,100 for 2 bedrooms. Significant upside before hitting affordability ceiling. Number 3, Boise, Idaho. Rent growth of 9.1% in 2025 after a brief 2023 correction. California migration remains structurally positive despite normalization. Vacancy fell back to 4.6% after peaking at 6%. New permits are lagging demand by approximately 2,000 units annually. Numbers 2 and 1, the highest rent growth markets in 2026. Number 2, El Paso, Texas. Rent growth of 9.6% year over year. Cross-border manufacturing expansion from nearshoring. U.S. companies moving production from Asia to Mexico is driving wage growth and population inflows on both sides of the border. Fort Bliss, the second largest U.S. Army base, provides military housing demand stability. Entry point pricing remains extremely attractive for investors. Number 1. Myrtle Beach Conway Metropolitan Area, South Carolina. Rent growth of 10.8% year-over-year. The fastest growing retirement relocation destination in the U.S. 360 moving trucks arriving per month net. Combined with restricted coastal development, Horry County's constrained permit issuance, and a 30% increase in tourism workers requiring rental housing. Vacancy at 3.1%. Two-bedroom median rent still below $1,400 with year-over-year growth double the national rate. What these 10 markets have in common. Every city on this list shares 3 characteristics. First, employment anchor, defense, manufacturing, federal contracts, university, or tech expansion creating jobs that don't evaporate with a single employer decision. Second, affordability headroom. Median rent is still well below 30% of median household income in the metro area, meaning tenants can absorb further increases before hitting stress. Third, supply constraint. Either zoning, geography, or development timeline lag means new units are not arriving fast enough to compress rents back toward the national average. The markets not on this list that had high growth last year, Phoenix, Austin, Tampa, share the opposite profile, supply catching up, vacancy rising, and rent growth reverting toward or below the national average. The supply warning. Rent growth without supply context is dangerous data. Austin is the case study. Rent growth of 18% in 2022 attracted record construction. By late 2024, over 40,000 new units had delivered in the Austin metro, pushing vacancy above 8% and driving effective rents negative in several submarkets, meaning landlords are offering free rent and concessions to fill units. Before buying in any rent growth market, check the pipeline. How many units are under construction and scheduled to deliver in the next 12 to 24 months? If the ratio of new supply to existing inventory exceeds 3%, rent compression is likely. All 10 cities on today's list have pipeline ratios below 2%. How to invest in rent growth markets. 3 approaches for different capital levels. Strategy 1. Single-family home in secondary markets like Huntsville or Greenville. Entry prices of $150,000 to $250,000. Institutional competition is lower. Property management is simpler. Strategy 2. Small multifamily 2 to 4 units in Columbus or Raleigh. Benefit from residential financing terms while capturing commercial scale NOI growth. Strategy 3. Build to rent in El Paso or Myrtle Beach. Land costs remain low enough that new construction at below replacement cost is still feasible. Yield on cost of 8 to 10% on new construction beats existing inventory pricing. Avoid buying into a rent growth story at a cap rate below 5% in markets with rising supply pipelines. The rent growth is already priced in, and the downside is a vacant property competing against 2,000 new units. Subscribe for weekly rental market analysis covering U.S. cities and international markets. Hit the bell so you don't miss the next heat map update.